49. So he's just breaking down the different business deductions first. So after he goes through that, I'm gonna let him run for about 5 minutes, and then I'll get back in the video, just so that you guys please look through these videos, because we have a test that we got to take of this information of these 6 hours on Monday. So make sure, I'm gonna be right there to help you guys and break down a lot of the questions, but it's 100 questions on this test. And I know that it's gonna be a little hard because you don't really understand how taxes go. But let's go back and listen to the videos. So really, the number one things that they're going to be testing you on is the itemized deduction. So just understand how that goes and understand how in what forms you guys will be fine when you take the test. If for whatever reason you fail, because I did the first time too. If you fail the first time, don't worry about it, because we're going to take a section maybe on Tuesday, and we're going to go through the answers so you can understand the questions that you missed and the ones that you get right. We're going to elaborate on that a little bit, and on Wednesday morning we're going to have everybody take the test to see where you are, go over the information that you missed, so that Wednesday, when we go and take that test again, you'll get those continuing education hours underneath your name with the IRS. That's the primary goal of all of that. So we're going to let him finish talking about this form, and we're going to go right into the next section.
And we're looking at lines 1B, 2, 3, 8B, 9, and 10. Again, just to give us this overall view of the capital gains tax form, Schedule D, how it works, what some of these lines are all about. So you figure the gain or loss on each line. You're subtracting the cost or basis, as we saw in column E, from the proceeds from the sale of the asset in column D. Remember, these are assets that we reported the basis to the IRS, and that's what's important. Taking a look at an example again, if we have gain, then our column D is 6,000. Our column E is 2,000, like our previous example. And we're going to show gain here on the far right-hand side of $4,000.
So basically, on this section here, he's still going through the Schedule D. And this is for the capital gains. Capital gains is what we've been talking about over the last couple of videos, and that is the sale of a purchase. Like he was using as real estate as an example. You made $20,000 and you're taxed at that capital gain rate if you held longer that property longer than a year. If you held it less than a year, you're taxed at ordinary income rate. So make sure you guys understand that. He's going to start talking a lot about the Schedule D over the next 30 minutes, but just try to get through it. I know it's gonna be hard because I had to go back and watch it myself a couple of times, but listen to what he's saying. He's breaking down this form. As soon as we get this form, you guys, I'm gonna print out all of the forms so you can visually see these forms on what you're gonna see, such as this 89, 49, the earned income forms. We're gonna go through the 1040s. We're gonna go through all of those forms so you can see how they look as soon as they become available to us from the IRS. There's no sense for us to familiarize with ourselves of forms that we're no longer going to be using. So there's no sense for me to pull down all these 1040s, all these forms, because they're going to be completely different come hopefully by December 1st, what the IRS is telling us.
It's a loss. Keep in mind that we want to show it in parentheses so that the IRS knows we're claiming a negative number on that part of it. Okay, just taking a brief look now, we're on slide 19, and we're looking at line 13 that says capital gains distributions. These are distributions that are paid by a mutual fund or an other regulated investment company or a real estate investment trust from its net realized long-term gain capital holdings. Distributions of these, of net realized short-term gains, are not treated as capital gains, as we talked about before. Instead, so if a mutual fund or a real estate company has a short-term gain, they're going to send you a 1099 DIV, and it's going to be taxed as ordinary income.
And that 1099 DIV is a dividend. So basically, at the end of the year, when you sold that house or you sold that piece of equipment and you made that $20,000 profit, they're going to send you a 1099 DIV. Make sure you guys are scanning the system. Well, when we get into the system, it's going to see. We're going to scan the system with their socials to make sure there's no outstanding forms. The system will tell us, hey, this person has a 1099 DIV. So no, it's not going to give us the whole entire form itself, but it's going to let us know this person has an outstanding form of a 1099 DIV. So at that point, we need to ask our clients, where is the 1099 DIV? You sold something, the company has already reported this information to the IRS, and we need that form. If you can't do it, make sure that you walk them through the process of trying to get that form. A lot of times, they don't know that this form is sitting available online waiting for them to print it out. So you just simply got to tell them, look, sweetheart, they sent you an email, or contact the company, tell them that you need to sign in information so that you can reset. Due diligence check is simply making sure that you ask your clients if there is any outstanding income. And if you don't do that, you will be penalized for simply not asking that basic question. Our checklist will have a list of all income that is outstanding, but a lot of times when people come into tax office, they just go through pieces of paper, and they just sign it and they keep it moving. They really never. So take your time to ask them, hey, sweetheart, you got any Social Security income? You got any dividends? Did you sell something? Did you pay into student loans? Did you actually pay into your 401k? Make sure you have a system of questions that you have in your head that you want to ask your clients. If you see on their W-2s where they have a DD section, that means that they have been paying into their medical insurance. A lot of times people have these flex savings accounts where they pay extra for medical costs so that they don't have to pay it at the time, the co-payment. So what they'll put is an extra little money to the side in these flex savings accounts. Whenever you put money into the side in these flex savings accounts, they never send them to you in the mail. It's always available online. So you want to ask your clients, when you look at their W-2s, if they have a DD on there, okay, did you put money to the side in a flex savings account? It's just as simple as that. You will be able to know once you start to look at the W-2s what type of forms they may or may not have outstanding, but also go through the fact that they ask them, did you sell something? What other form did you possibly could have? Did you get Social Security? Did you get disabled? Did someone in your family die and you was a beneficiary and you got a life insurance check? You want to make sure that you ask those questions, because that's income. Depending on how you report that, depending on how that income is received, it's going to be taxed. Some of it will be taxed, or some of it won't be taxed, but you will determine that when you have that form and when you input it into the system.
An ordinary dividend. Now, when I say that, let's explain what a dividend does for a company. If a C corporation issues a dividend to your client, it's not deductible to the company. So they pay it after they've paid their salaries and their expenses for the year. They may have some profit available, and then in order to distribute those profits, this is going to come into play very importantly when we talk about C corporations later. C corporations are not allowed to accumulate too much profit. Depending upon the type of business it is, it may be able to accumulate $150,000.
So there's going to be a section where we go through the actual business structures. But for what he's talking about right now, so you can understand what a C structure does compared to an S corp. A C corp will benefit certain people in certain areas who expect to have annual profits like either $60,000, $70,000, $100,000. So under that C corporation, what he's saying right here is you can't accumulate too much profit. So at the end of the year, you have to disperse down this profit. You have to pay it down to the shareholders and also the owners that has equity in the company. So for example, Sister Kim was just talking to me about a business idea that she wanted to do. And she was saying, okay, Brandy, if I made $100,000, this is what I want to do, $50,000 or whatever it is each month I want to do with those profits. So she was going through the list of things that she wants to do with that income. This is where she'll be limited if she puts it under a C corporation. If she put it under a C corporation, then guess what? She's maxed each year of how she has to distribute that income down to the shareholders and also herself. So instead of her accruing the income each year under the S corporation, she's limited to pay that out each year. So make sure you understand that between the C corporation and the S corporation, $100,000 in profit, you can pay yourself because you have done work in this company. So, and a lot of times because you are the owner of the company, you don't pay yourself because you have other financial obligations of making sure the business run correctly. So at the end of the year, if you have this $100,000 profit, you can pay yourself $60,000 of that and not be taxed on the other $40,000 that you have to pay. Now, when you under the C corporation, this $100,000 now is going into dividends, and that the dividends is taxed from the company's point of view, meaning that they taxed on that $100,000 before it's sent down to the shareholders and it's sent down to the owner equity. But also the C corporation, the individuals who receive those dividends also have to calculate that income, that money as income. So they have to put that on their income taxes too. So depending on how you are invested into the company, you will determine on how you want to, if you how you want to structurize that company. Now, if say C corporations are big corporations that want to start off and they don't have the money for the technological advancements, they're small in their industry and they need funding. They need individuals to invest into the company. So they start to give away shares and profits of the company, which in turn turns down to a dividend. So when that dividend is paid out, that's 50% of the company has a stake as shareholders. So 50% of the profit goes down to these shareholders. So when you get into business structures, know how these structures work. If this is a C corporation, I'm asking for people to put money into my company, and I owe half of that down to these people. After I pay these people, I'm taxed, and they're taxed on this as this income. But as a S corporation, you're the owner, it's either two parties, well, not two parties, but it's one party. You've put majority of the money income, the profits belong to you. If you have $40,000 left at the end of the year, you can carry that over onto your books for next year. You don't have to be limited of actually sending that down to shareholders. So I'll let him go back into this.
$1,000 of profit to $250,000 of profit. It can accumulate more if it has a reason to accumulate it, but if it doesn't, it issues what it calls a dividend. It's paying tax at the flat rate of 21% on those dividends, but they're not deductible to the company. Then the clients receive them.
Right.
So what you're going to do.
So the company cannot deduct what they paid out as dividends. So if they paid out $50,000 in dividends, they can't take a $50,000 deduction on their taxes because they paid down that dividends of $50,000. That's why I said S corporations, you're taxed at the dividend rate at 21%. So that $100,000 is already taxed at 21% for the company. And you as the business owner of that company can't write off of what you paid. So why would you need to unless you are a multi-million-dollar business, do not get into a C corporation because the tax benefits is not there for you. If you're a multi-million-dollar business, then yeah, it would make sense for you to be in a C corporation because your half of this profits you have to legally pay out to these shareholders anyway. So it helps you keep honest and money. So unless you're a multi-million-dollar business, try to stay away from that C structure just because it's just a whole lot involved in it. And unless you're making millions, you just don't have the tax benefits that you would if you have it under S corp.
You're going to enter on Schedule D, line 13, the total capital gain distributions paid to your client during the year, regardless of how long they held their investment. And this amount is shown on box 2A of Form 1099 DIV. If there is an amount in box 2B of the 1099 DIV, you include that amount on line 11 of the unrecaptured section 1250 gain worksheet. Now, we talked about recapture when we talked about depreciation. I know we're throwing a lot of things out there now with these changes. We talked about recapture. But if you see box 2B on the 1099 and it has a number in there, that's what you're going to use as, oh, that's gain they have not recaptured, and they have to pay tax on that gain because it's not recaptured like we talked about before.
And that recapture is what he's talking about, is when you depreciate that asset, you depreciate the building. So you start to write off the depreciated cost of that building each year. So each year you have a building that you're depreciating. Each year the tax, the schedules tell you what the depreciated cost is for that item. So say for instance for 2016 you owned a building, 2017 you owned a building, and the depreciated cost in your district, in your county is this. So you get to write off $6,983 because that's the depreciated cost of that building each year. But you have to pay the recaptured amount on that $6,000 the following year. So when you depreciated this, yes, they gave you a tax cut for it, they gave you a deduction for it, but you still owe taxes on that $6,938. And it's usually not that amount that much, but what he said is when you get these DIVs, the DIV is a self-explanatory form. It's going to tell you.
Hold on, switch it around. All right, we're back.
If it received capital gain distributions
So like I was saying, in that box number 2, you want to make sure that you fill out that worksheet. And box 2 is going to be self-explanatory. When you see something in box 2, you're going to pull up that worksheet, and then that worksheet is going to bring down everything that you need to fill in the worksheet.
as a nominee for someone, paid to your client, but they were actually for someone else. I'm going to explain this in a second, but that gets reported on Schedule D, line 13. Only the amount that belongs to your client. Attach a statement showing the full amount that your client received and the amount that they received as a nominee. In other words, the amount that doesn't belong to them. There's 2 ways to kind of attack this. If you receive a 1099, your client receives a 1099 and they say, but that money was for somebody else, or that money was for another entity. And here's the example, and here's the ways to attack that. And I'll give you my own example. So I have a brokerage company. I receive rents for my brokerage company that belong to my real estate holding company. I own the real estate in one entity. I manage the real estate from another entity. So my tenant pays my brokerage company, but the money belongs to the property holding company. That is exactly what we're talking about here on Schedule D, line 13, if it really belongs to someone else. But there's 2 ways to approach it. One, the way I just described, to attach the statement showing the full amount that I received and the full amount I received as the nominee for that other entity. Or I can expense it. I can say, well, I received this amount on my Schedule D as a distribution of some type of capital gain, and I distribute it or I expensed it to my other entity. And then it would just simply show up on my P&L or on my expense statement. So just kind of keep that in mind, that there's 2 possible ways to approach that.
And then you guys, once we start getting more into the real estate taxes, you'll see why he set up 3 different entities in order to avoid paying taxes on each one of those structures. So in tax planning, you will go through a lot of different scenarios, which is the last week of our classes. We're going to bring in all types of different scenarios on where you will have to start to tax plan for your client. what will put them in the best situation and what structure, what is their ultimate goal. Their ultimate goal in his situation is to buy and manage property, but it wasn't beneficial for him to do it all under one company. So one company buys the property, the other company is selling managing the property, and the third company that he set up is receiving the profits from the management and the purchases between those two companies. So at the end of that third company down there, that's the company that's going to pay the taxes instead of paying taxes across the board on 3 different companies. So tax planning is a lucrative business, you guys. I promise you, so many people come in and they want to know what to do with my 401k, what to do with my Roth account. I own a piece of property. What should I do to avoid paying not only property taxes, but also taxes to the IRS and to the state? You will start to develop ideas in your head on how to make sure that each one of your clients is addressing their taxes in a planning way, because taxes is something that you want to plan for. You don't want to go through each year and say, oh, I don't know what I owe. What you mean you don't know what you owe? That bracket is going to tell you owe 10%, you owe 12%, you owe 23%, you owe something. So how do we plan for the fact that you owe this as a tax that you have to pay each year? So tax planning is a lucrative business. I have a lot of people that I do Kentucky Fried Chickens for, who I do a lot of small businesses, and they want to know what should I do. I put a lot of people from up out of LLC structures because they just simply incorporated instead of doing the articles of an organization, meaning that eventually down the line this entity is going to get off into other businesses. So limited liabilities would limit them into doing that. So when we get them into the S corporations and the series LLCs, then you'll see why it's better for when people have more ideas than just that basis business to get them into a LLC series, meaning that we're going to have another 2 series where this business does this one does this one does this. So it's a difference in how you want to make sure that you structurize your company business. And tax planning, you have to know it. It's more than just inputting numbers like I told you in the system. Those days are just inputting numbers in the system is over. You're going to have to advise your clients on how to deal with their taxes on a yearly basis, because the CPI chain is going to change each year. You will not pay the same taxes that you paid in 2018. Each year, you're going to have to show your client, how do we address this year? What do you plan on doing this year? Do you plan on opening up a building? Do you plan on buying a piece of property? Do you plan on having a rental property? What is it that you planning on doing so that we can know what the tax ramifications of those types of decisions are?
Okay, taking a look at Schedule D, line 18. So if you checked yes on line 17, you have to complete the 28% rate gain worksheet here on line 18 and put the figure into there. If you reported in Part 2 of Form 8949 a Section 1202 exclusion from eligible or qualified small business stock, and then it would apply. And I want to stop you right there. If you have a client, this is where this comes in, so you understand this line and why we're talking about it this year. If you have a client that sold a stock of a company that they stock sometime after September 1st of 1993, so you have to ask yourself, okay, Roman's talking about a capital gain on the sale of a stock and why we have to report it. And maybe it is excluded from taxability under this qualified small business stock exception on Schedule D. If your client had owned a company that they may have started after September 1 of 93, or maybe they bought the company after September 1 of 1993, and they got something called, and they ran the company as a C corporation, as an 1120, they're filing an 1120 tax return, it's maybe considered qualified small business stock, and it would be reported on Form 8949, and potentially the gain from that sale is completely excludable. Now, let's talk about,
So, it's gonna be rare that we find, clients or had clients who opened a business back in 93, in 93, and have, who have sustained this business, or this business have survived all this time, and they issued out stocks or dividends to individuals. Instead of them claiming that amount, you have to still show it. Any income, you have to still show it on the tax return. You can't just say, oh, well, it's not taxable, I don't have to put it on there. No, you do. And when you do put it on there, he said that on this worksheet, he's breaking down this worksheet, is that when you put it on this worksheet, that amount is gonna be excluded. However, you still have to show it. The IRS is not gonna let you get away with not showing income. They will penalize you, and it will be interest from the date that you filed the tax return and did not apply that income. So a lot of times people had income back in 2015. They excluded their income, meaning they didn't add it for whatever reason. Maybe you didn't know about it, maybe, well, whatever went on, it was not excluded. They're gonna penalize you, and they're going to charge you interest from the date of that penalty. So the penalties usually run about $1,500, and then you have interest for 2 years on that $1,500. So make sure that you understand, that's why we're gonna be sweeping the system to if there is for protection of our clients. A lot of people don't know they have funds. A lot of people get into stocks and bonds and don't know what type of forms that they're going to get at the end of the year. Make sure you ask questions. Did you buy into a stock? Did you buy a bond? Did you buy into a series bond? Did you own a business at one time and you issued out stocks? It's gonna be hard for you not to remember that, but I'm just saying, you guys gotta get in the habit of asking clients all type of questions. And then when you start to asking questions, believe it or not, that's tax planning for yourself. I make a lot of money towards the end of the year in October, November, December, because I'm addressing people and I'm tax planning for the next year. They pay you a cost, I charge them $120, $125, they bring me in their forms, and we get prepared, not just to file their tax return is totally separate. We're gonna tax plan for the next year, meaning that you're gonna bring in what you made for this year. We're gonna look at the CPI chain index to see what you're for next year, and we're going to start to plan towards that tax burden. That's what I'm telling you. You will have a lot of people who come in here and they just want to know, how do I make sure my W-4s is right? That's not a free service, but you want to make sure that it's done correctly. Even if you have to wait until the end of the year, okay, sweetheart, they don't have the money, $50 consultation, come in, $50, we'll do it, and we'll charge you the $75 when we file your tax return. You can legally do that. But you want to make sure that you start the tax plan, because when you start the tax plan and start to generate ideas, people start to get involved in more things. So instead of them saying, hey, sweetheart, did you have any stocks? They say, no, but I think I want to get off into stocks. That's another way for you to make sure that you can eventually help them in that area, because we will get into stocks and bonds next year, you guys. I promise you, we will start to refer our clients to different types of investments. And one of the things that I want to get into is what I personally have done for myself, and that's get into certain types of stocks, get into certain types of bonds, get into certain type of financial agreements that you can buy off into. And eventually we're going to crowdfund hopefully by the end of next year. So make sure you guys simply start the tax plan. It's a great source of revenue. Your clients will always be clients if you address their needs. If they need your help throughout the year, do not ignore them, because they're coming to you because they need your help. They need you to address this. So if it's you having to help them get together to get the proof to the IRS, do that. Because it's going to be in your best interest to help your client get through whatever it is, because they're going to say, you know what, the IRS sent me this whole little paper, she worked to do, she did whatever she had to do, and she got it through. And they're going to refer other people to you because you have taken the time, you have listened to what they said, and because you did the work, you need to help make sure that your work is done correctly. And maybe it is something you did wrong, or maybe it wasn't. But the fact that you did prepare the return, don't leave that client out there hanging just because you paid, just because you filed it. Yes, our legal responsibility is over once we file that return and it get accepted from the IRS. But people deal with issues after those returns all the time. Deal with those issues. Do not leave them to hang.
Another thing, let's say it wasn't stock. Let's say they reported a collectible gain or loss. What's a collectible? Well, maybe they sold a work of art, a rug, an antique, metal, gems, stamps, coins. Actually, we even include alcohol beverages in collectibles. What if it's an old bottle of wine?
I was gonna say that, you guys, my sister, she was over and she did a trip over there to Spain, and she spent a nice little piece of penny on this bottle of alcohol. And she wanted to know if she sold that bottle of alcohol, would she have to pay taxes on the profit? And the answer is yes, you do. And this is where you report this at on the Schedule D, line 18. And that's for any like any extraordinary type of situation, such as you sold wine, or you sold alcohol, or you sold a collectible, or you sold a piece of art, or you sold something that was a piece of clothing that was vintage. You have authentic types of thing, or you sold an older authentic type of car. That's where you will put this capital gain information at. On this line 18 of this worksheet, when you on the first Schedule D, line 2, this is the worksheet of where you're going to put this information on. And like I said, we will see the new forms. We will walk through them. Y'all will get familiarized with it. Y'all going to say, oh yeah, Rowan was talking about that Schedule D. Oh, this is how this Schedule D look like. And we're going to go line by line through each one of the forms so y'all can understand how to fill that out when we get them. We're not just going to rely on this because this is great information, but we're going to need to know, okay, well, what if this box come up? What do I check? What do I put right here? What happens when I pull this form up and this worksheet comes up? I don't know what the hell this is. You will know. You will know what to do. And we're going to put generic DIBs in there, just so y'all can know how to work them down. And I'm going to give you realistic numbers, not just, okay, it was $1, put this in. No, you're going to get a realistic DIB. Okay, somebody sold $19,000. I want to make sure that after preparing this business tax return, you had $90,000 in income. We're deducting it down by 60%. Once we're done with this business tax return, what is that profit? We're going to go through step by step of each structure to make sure that we properly is doing these business taxes right. And if you know how to do a business taxes, believe me, the personals are nothing compared to the business one.
With an old vintage date on it that can qualify as a collectible or other certain intangible property, then that qualifies too. You include on the worksheet any gain or loss from the sale or exchange of an interest in a partnership, of an S corp, of a trust held for more than 1 year and attributable to, again, those potential appreciation of collectibles as well. I want to talk about something else here too, as we talk about, okay, so maybe I did sell an interest in a partnership and I've got to do this rate gain worksheet. Maybe I sold an interest in an S corporation and I've got to do this, I made a gain on the sale of my S corporation. So we've had a lot of this happen this year. The field of buying and selling companies has exploded because the economy is doing much better, lending is available, and this comes in right here. If your client sold their company during the year, you're going to be dealing with this worksheet and say, okay, so do I have a gain or loss if they sold their stock? You have to think about something else too. If they are, let's say they sold their company mid-year. Did you know that they're taxed on the profits of the business for the entire year, but divided by 50%? If they sold it on June 30th, they're potentially taxed on the profits of the company to the end of the year, just divided by 2, saying, well, you own the company for half of the year, so you're taxed on half of the profits for the year. That's the standard method, what we call the regular, what we're talking about on line 18 when we do the rate gain worksheet.
So going back to the rate gain worksheet, it's a little, it's not too complex, but what he's talking about is if you and your partner own a company, and for whatever reason you felt like you have medical practices where you will see a lot of medical professionals. 2 people open up a medical center. One of the doctors is getting older, he wants to retire, so now he wants to sell his interest in the company. He can do that. But what he's saying is he's going to be taxed on that capital gain, meaning how much he sold. So he initially put in $100,000. He sold his interest to the partner or to the shareholders, depending on if he got a C corporation or whoever. He sold his interest in the company, and he made $250,000. So $150,000 of that is taxed. $150,000 of that amount is taxed. However, for 12 months. So if he sold his interest in the company in June, he's still taxed for the rest of the year on the profit the company made. Now, when it goes to how he individually is going to pay that tax, so a lot of people say, well, you know what, Brady, he sold the company in June. Why do he still have to pay taxes on the money the company still made profits on for the next 6 months? It's mainly because he's only going to pay half of the taxes. He first is going to pay, out of the $150,000 that he paid, he's going to pay that capital gains rate. That's the one we was talking about. The 0 to 15%, sometimes 21%. He's going to pay that. But if the company made an additional profit after he sold his interest, because the IRS recognized the interest of any business for 12 months, not for 6, not for 3, not for 9. So they recognize and they are expecting you to file an annual tax return on that business. When you file that return, you're going to show that this person sold their interest in the business. They made $150,000, they're taxed on 21%. The additional money that the company made, they have to show it, but it's not taxed. So this is what he's saying. You still have to show it. They're going to send that 1065, even though he sold the information, he sold his interest in the company in June. And by law, that other partner still have to send him an annual statement of what the other 6 months of that profit was for, because he has to address the 12 months, not 6 months, and he has to report it, not pay taxes on it, that his interest in the company for the 12 months was this, he sold it for this. It's kind of complicated, but not complicated if you really look at it. The IRS recognizes your business as 12 months. You owe taxes for 12 months. Just because you sold your interest doesn't alleviate your responsibility to pay taxes to the IRS. They don't care when you sold that business. What they are expecting is for you to file an annual tax return. But when you fill out this Schedule D, in this section, what he's talking about on line 11, you're going to break down how that partnership was paid out.
And you may say to yourself, well, that doesn't sound right, Roman. My client sold his or her stock on June 30th. Why are they paying taxes on the profits of the business for the whole year, maybe divided by 2? And you may say, well, the profits were bigger in the second half of the year, so it's hurting them because they're paying tax on profits that they didn't really have. Well, there's a method they can elect, and it's called closing the books method. And all of the shareholders in the company have to unanimously agree. So be very vigilant. If you have a client that's selling their company during the year, you have to deal with this line on Schedule D, and you have to deal with how are they allocating the profits of the business for the year. Closing the books means exactly what it says. You're going to close the S Corporation or flow-through's books on June 30. And your client, if they're a 50% shareholder, they're going to pay taxes on 50% of the profits. Remember, again, less 20% for 2018 forward. Let's not confuse it too much, though.
Right.
If they close the books on June 30th, now what happened? They're still paying the right amount of tax, and now no matter what happens from June 30 to December 1, they're not a part of that. That starts a new book for the new owners, and they start fresh. So keep that in mind.
And that's with that C corporation, you guys. That's what he was talking about, that the shareholders have to unanimously agree to the fact that the books are going to be closed at the halfway mark. So you will do that. You will, when you do this tax return, you're not doing it at the 6 month mark. You're doing it when you actually filed the return. You're gonna go back and say that the books was closed on June 30th and the additional profit gain is going to be excludable, meaning that when they send him down that partnership statement, it's going to show you where his interest was, so for the first 6 months, and it's going to show you the profits that was made after the 6 months. When you apply that tax return on this worksheet, it's going to say books closed on what date, and you're going to put in June 30th, 2018 is when his portion of the books was actually closed. So, like I said, you guys, that C corporation has a lot of ups and downs and ins and outs and all of these different things. But when you fully understand them, it just becomes like arms or legs. You're just, okay, has this a part of this or has that a part of this? How I always look at C structures is that it has arms and legs. What form of the C, and it's like a body. It's gonna have this structure, this, and this. That's how C corporation operates. But with the S corporation, you can put it as one entity standing alone, and you determine on how this business is gonna be taxed and how much income is gonna be taxed on there. So I know it's, you probably won't see this, or you probably will. But it's better for you to prepare yourself for scenarios that you may not see than to get in them and not even know what's going on or how to address it, or not even have no information about what they talking about. Because if they come to you and say, hey, I have a 1099 DIV, and you don't know what that is, they're going to be like, I don't want you to prepare my tax return because you don't even know, I don't even know what that is. So now you guys know what that DIV is. They had some interest in the company. They had a stock that came down from the company, and the company paid them because they had interest in the company. So you will understand what those DIVs is, those 1099 Social Securities, 1098s. You'll know about all of these interest statements, and the number ones that we're gonna see, we'll have a whole list. And you can always go back to the books that we have in the office and refer back to that form. Okay, this is what this is. This is what the students get. This is what people who own stocks and bonds get. This is what this person who have filed head of whole household, this is what they get. We'll be able to refer back to what those forms are, and I will write down, okay, what type of scenario did that this situation happened for you to get this form. Oh, okay, they had a real estate statement. Okay, well, this is a real estate statement. You'll know what this is so that you are not just blown away. And like I said, the best thing is that you want to let your clients know is we're going to tax plan. We're going to look up a whole lot of different scenarios so we can know which situation to put you, the best situation to put you in. Never say, hey, I'm gonna get this done if it's a complicated situation in a day or two. You never know it's going to take, and you may have to build to know which one is the best outcome from your client. A lot of times you have to build the returns to see, especially when it comes to business taxes, because you need to say, okay, hey, if I write it off here, what do I get? But what if I flip it right here and put it on the Schedule C? What can I get it from here? Or if I put it under that 1065 and I say, you know what, her mother did have interest in that company, and I write off this part here for the mother and write off this part for the company, the daughter. Now I can see, okay, it's better for you guys to go next year and make this a partnership opposed to you making it a LLC and you just taking on this. So you will see that. I promise you, you're going to see all types of situations. And a lot of times people don't think that minorities have these statements. They do. They have these statements. They have 401ks. They have Roth accounts. They have retirement accounts. They have dividends. They have real estate accounts. They have businesses. So don't think just because you are a minority, you will never face these situations or that you're.
Okay, you said truck.
Okay, yeah, you're gonna see truck drivers, and they're gonna have interstate taxes, they're gonna have gas taxes, they're gonna have all type of taxes that they're gonna have to pay, and you're gonna need to know where to put that money, how to write it off, how to allocate, how to collect it. I have QuickBooks on my system, and I'm gonna make sure that you all guys have it to share. It's a little more expensive for me to do it on a business level. That's QuickBooks individually on all of your computers so that you can start to input clients' companies so that you will become a bookkeeper as well. If you're doing their taxes and they're a truck driver, it makes sense for you to carry and do their books so that you can know to let them know, hey, it's the 3-month mark, sweetheart. You owe $693 to the IRS because we're allocating your taxes. So send them $693. You will become their bookkeeper. And this is another way for you to generate a new skill, to generate money, is by bookkeeping. I know a lot of people keep up with their books, and you simply going into QuickBooks. QuickBooks is not an easy program, so don't think that it is. You're gonna become proficient with it. QuickBooks has a class where they can walk you through. It's worth paying the $69.99 to go through that QuickBooks class and become proficient and certified in it, because when you do that, they put you in their system and they let people know, all type of business owners, that you are proficient in QuickBooks and that they can benefit by taking your services. So a lot of people who have own business don't have the time to do their books. They just don't have it. So for you to maintain their books throughout the year, not only is it a monthly fee, but it's an annual fee, and you get to file their return at the end of the year. Bookkeeping is a great way to make sure it goes with taxes. So understand that, you guys.
As we've seen that kind of pop up a lot. There's actually a third method that you can employ when you're looking at that, when you're looking at the sale of a closely held business or a flow-through entity, and you're doing this line on Schedule D. It's called the reasonable method. If for some reason you have a reference point to divide the year use, is actually an attorney like myself. What if I sold my interest in my law firm filing an 1120S flow-through tax return? I sold it June 30th. But what if I'm part of a case and I'm still owed part of a case that's going to settle in September or October of that year? Well, we can tell the IRS, we're going to divide profits as of June 30th, but then we're also going to give a partner X amount of profits from the settlement of this case. It's a reasonable method that the IRS will allow. And that's part of what you have to be thinking about. Okay, just taking a quick look at Schedule D, line 19. So if you checked yes on line 17, as we talked about before, completing the unrecaptured section 1250 gain worksheet, you would do this if any of the following apply for 2018. If your client sold or disposed of section 1250 property. That's a term you should really start to understand. 1250 property is generally real property, real estate that your client has depreciated and held for more than 1 year. We call it 1250 property. And you're going to hear maybe there was a CPA involved in the transaction or an attorney, and they're going to tell you, hey, this was 1250 property that we sold, and you're dealing with line 19 of Schedule D.
Is he's a real estate guy, so he's talking about more real estate, and that. 1 second.
Can I pause this?
Yeah, pause it.
How?
Press it.
Exit, yeah. I did press OK.